Welcome to Talk Tickers. Today, we are unpacking Build-A-Bear Workshop's Q2 earnings, and honestly, the results were just stunning. Let's dive right into the numbers that really moved the market.
So, let's get straight to it. The headline number, Build-A-Bear, reported earnings per share of 94 cents. Now, that might not sound like a lot, but it absolutely crushed analyst estimates. We're talking by over 25%. A huge beat.
And you know what happens with a beat that big, right? The market responded instantly. The stock surged a massive 17.8% in pre-market trading. This was a classic beat and raise that really got everyone's attention.
So, this all leads to the big question we're going to try and answer today. How on earth is a company known for stuffed animals putting up these kinds of incredible results, especially in such a challenging economy? Well, the answer starts with just how historic their performance was.
Yeah, and let's be super clear here. This wasn't just a good quarter. It was the best second quarter and the best first half in the company's entire history. Let that sink in for a moment.
The outperformance here is pretty staggering when you dig in. Revenue beat the consensus by a cool $8 million, and pre-tax income jumped nearly 33%. But here's the really interesting part. Look at that line for e-commerce. It actually saw a 15% decline. So what does that tell you? It suggests the real story isn't just about online sales. It's about how they are successfully driving customers back into their physical stores. Let's explore how they're pulling that off.
So where is all this growth actually coming from? Well, you can bet it's not accidental. It is the direct result of a very deliberate, very smart, three-part strategy.
So, management has built this incredible success on three core pillars. First, expanding their global retail footprint. Second, accelerating their digital transformation. And third, leveraging their powerful brand equity into totally new product lines.
Let's start with that first pillar, global expansion. The CEO, Sharon John, said it best. It's all about taking this iconic brand to more people. And they're doing it with this really clever, capital-light, partner-operated model. What that really means is they can grow fast without a ton of risk or having to dump a bunch of their own money up front.
And believe me, it is working. They opened 14 net new locations in Q2 alone. And get this, a staggering 86% of them were international. The brand is now in 32 countries.
You know, the COO Chris Hurt really summed it up perfectly. He said a teddy bear hug is understood in every language. And that's just it, right? The brand's core appeal is completely universal, which is exactly why this international partner strategy is proving so effective, with new stores popping up everywhere from Georgia to Colombia.
Okay, on to pillar 2, digital. And listen, they're not just, selling stuff online. They're creating viral trends on TikTok and Instagram. They're targeting that super lucrative kid alt market, teens and adult collectors. And they're using social media to drive traffic not just online, but right back into the stores.
The third pillar, leveraging brand equity, is where this story gets really, really interesting. The absolute star of this strategy is a tiny product line that's having a huge impact. It's called Mini Beans.
So this collection of small, affordable collectibles saw an incredible 80% year-over-year revenue increase. It's just wild. And now they're expanding into wholesale channels, so you'll start seeing them in places like Hudson Airport stores and even some upscale convenience stores.
But of course, this growth isn't happening in a perfect little bubble. The company is also navigating some pretty serious macroeconomic headwinds, which, frankly, makes their performance even more impressive. So on one side, they're facing rising tariffs from China and Vietnam, plus increased labor and medical costs. But on the other side, they're being incredibly proactive. They're using dual sourcing, strategically pulling inventory forward, and, this is really smart, they're doing selective price increases on collector items while protecting those entry-level prices for families.
And just to put a number on it, the company is successfully navigating nearly $16 million in total expected headwinds for the year. That's almost $11 million from tariffs and another $5 million from other rising costs. That's a lot to absorb.
So when you have that kind of strong performance combined with really disciplined cost management, it gives management the confidence to go ahead and raise their outlook for the rest of the year.
And the key point here is that this was an upward revision across the board. They raised revenue growth guidance, they increased their pre-tax income forecast to a range of $62 to $70 million, and they now expect to open at least 60 new locations this year. That's up from their original plan of 50. Looking ahead, there are several key catalysts that investors should definitely be watching. The continued international growth, for one. The wholesale rollout of Mini Beans is another huge one. There's also a product launch in October tied to the Wicked movie sequel. And of course, the big one, performance through the crucial holiday season.
So with record results, a clear strategy, and raised guidance, what's the actionable idea here? What's the next call? And before we share our final call, just a quick, but very important reminder.
For our next call, we actually see a potential two-part play. Part 1 is a long-term bullish bet on Build-A-Bear's whole evolution. You could use long-dated call options to get some leveraged exposure to the upside if their global strategy keeps outperforming. Part 2 is a hedge, shorting a basket of those traditional toy retailers who just lack Build-A-Bear's experiential and omni-channel advantages. So based on this whole analysis, we are initiating coverage with an outperform rating.
And that really brings us to our final thought. The evidence points to a company that's successfully transforming into a global omni-channel brand. The question is, are we seeing them craft the new playbook for modern retail right before our eyes, or is this just a massive stuffed animal bubble that's waiting to pop? This is not financial advice.